Hello everyone, welcome once again. Let's start our learning with a famous quote from Tony Martins. Many people rush into the game of investing thinking they are the predators. When they get to the middle of the game, then they realize they are the prey and try to escape, but it will be too late. Only the prey with a well-defined exit strategy will escape. The rest will be sorted by the real predators. In this video, we'll understand the basic of options. So, in order to do effective option selling, one has to clearly understand the payoff of options. Let us understand first what is an option. The technical definition of an option that you can find on internet is as options are financial instruments that are derivatives based on the value of underlying securities such as stock. An option gives the buyer a right but not an obligation to buy or sell the underlying at a specific price and at a specific date. There are two types of options, namely the call option and the put options. If you buy call option, you are buying the right to buy underlying at a specified price, a specified number of shares with a specific date. And if you are selling call options, you are selling rights and collecting premium. In the similar manner, if you buy put option, you are buying the right to sell underlying at a specified price, a specified number of shares with a specific date. And if you are selling put option, you are selling right and collecting premium. Each option contract carries a specific expiration date, and before that buyer must exercise their option. The buying price of an option is known as the strike price. So call option and put option form the basis for a wide range of option strategies designed for a hedging income or speculation. Let us understand this through one example of TCS. A spot price, which means cash price of TCS, was rupees 2,279 and 50 paisa on 30th July. Also, let's assume we have bought one lot of 2,500 strike price for 27th August expiry contract at rupees 25. This means we have spent rupees 7,500 to buy this call option. Including the premium amount, your total effective price is 2,525. There are other costs also involved, for example, brokerage, security transaction tax, service tax, and other costs, which we will cover subsequently in this video. Keeping in mind your cost of acquiring option at rupees 2,525, you'll earn a profit on expiry, which is 27th August. If the underlying value, that is TCS spot price, closes above your purchase price on 27th August. Your profit will be spot price minus your cost of acquiring. For example, if TCS closes at rupees 2,600, your profit will be rupees 30,000. And if TCS closes below 2,525, your loss will be limited to rupees 7,500. Let us consider same example, and instead of buying the 2,500 strike price option, assume you have sold it. The payoff will be exactly opposite. So if the price on 27th August is below 2,500, you will earn rupees 7,500, and that is the premium that you have collected. Based on the real price on 27th August, TCS closed at 2,248.40, and you would have earned rupees 7,500. Important thing to note here is that you have sold out of the pocket call. We'll look into this concepts in subsequent videos. Let us understand the payoff of put option. As mentioned, the put option is the right to sell a contract at a specified price at a specific date, but there is no obligation. As the spot price was 2,279, we have selected out of money option with 2,000 as strike price. If you are a buyer of put option, you would have spent rupees 3,000 to purchase the right to sell on 27th August at a premium of rupees 10. Your net Net cost will be 1990 rupees. As in put option, it will be strike price minus the premium. If on expiry spot prices closes below 1990, you will have profit. Otherwise, you will lose your premium amount. Let us consider the same example, and instead of buying the 2000 strike price option, assume you would have sold it. The payoff would be exactly opposite. So if the price as of 27th August is above 1990, you will earn rupees 3000 that you have collected after selling the option. Based on the real price on 27th August, TCS closed at 2248 rupees 40 paisa, and you would have earned rupees 3000. The important thing to note here is that you have sold out of the pocket put. We'll look into these concepts in subsequent video. So in nutshell, we have seen in the above example that selling out of the money options, either call or put option, both have resulted in a profit for you, net gain for you. We'll understand in the money, at the money, and out of the money options in the next video. It is important that you go through this and the next video to develop your fundamentals correct. Let us end this video with one of the quotes from Warren Buffett. Diversification is a protection against ignorance. It makes very little sense to those who know what they are doing. Thank you once again very much and happy learning.